The financial information provided in this content is for informational purposes only and not for the purpose of providing specific financial advice. Please contact a financial professional to obtain specific financial advice.
You might think I'm the kind of person who would own a lot of bonds. I'm pretty serious about investing for retirement, and I'm more than halfway through my career. So at this point in my life, maybe I should be moving money from some of the stock mutual funds in my retirement account, whose prices have seen a lot of ups and downs, and into bonds, which generally enjoy more stable values. Particularly because I'm basically a buy and hold investor. Now, in case you were wondering, a bond is a security issued by a government or corporation, and they allow you to borrow money from many investors at once. Issuing bonds is like taking out a loan, but with many lenders. Bonds are a bit different from loans in two ways, though. First, bonds repay their principal all at once on the maturity date of the bond, rather than installments over time. Second, between issuance and maturity, bonds pay interest on the principal every 6 months at a rate called the coupon rate. It's called the coupon rate because in the old days, people would literally have to send in a paper coupon attached to the bond, and then the bond issuer would send the investor an interest payment. The big advantages of bonds over conventional loans are that they can be used to raise capital from many investors, that the debt can be traded easily, and that the value of that debt can be adjusted to market conditions. For example, let's say a city government wants to raise $100 million in capital to expand a highway. Getting the entire amount from a bank might be challenging, especially if the venture doesn't fit the bank's risk profile or the terms banks offer are unattractive. Issuing $100 million worth of bonds in $1,000 increments would allow many thousands of investors to buy a very safe investment backed by the city's tax revenues. The bonds may have a maturity of 30 years, but the investor doesn't have to hold on to it for that long. They may choose to hold for a while to collect some interest and then sell the bonds to other investors to get their principal back early. If you sell a bond before its maturity date, though, you do face the possibility that the bond price will have changed from the price you paid for it. For example, if the city's finances are in good shape and they've serviced their bonds reliably, and if market interest rates have fallen so that the city's bonds now pay an above-market coupon, other investors might be willing to pay $1,005 for that $1,000 bond because it's a good investment given market conditions. But if things have gone downhill for the city and there are doubts about its ability to pay, you might only be able to sell the city's bonds at a discount. In this way, the bond market helps assess the underlying value and risk associated with debt. Bonds that pay out steady coupons, like clockwork, ought to be very attractive to someone like me. And yet, I don't own any. It's not like I have something against bonds. In fact, I really would like to invest in them for the reasons I just mentioned. But I guess you could say that the bond market and I don't see eye to eye. For quite a while, the interest rates the bond market has been setting have been too low to suit me. In this lecture, I want to talk about why that is, and some of the unusual dynamics of the bond market that make it a somewhat paradoxical place to invest at times. Now, the first consideration for any investor in any market is that their investment should give them a reasonable shot at doing at least a little bit better than inflation. If your money grows slower than the increase in the cost of living or inflation, then over time the standard of living you can afford will shrink. That's not quite as bad as not investing at all, but it's still a pretty bad outcome. On the other hand, if bond rates can deliver a small return over and above inflation, even 1 or 2% on average, then a long-term investment in bonds will grow your wealth noticeably even after inflation. Inflation and interest rates are part of the dynamics of the economy that every investor should be thinking about. Sometimes interest rates are so attractive that some of the best places for your money are savings accounts and certificates of deposit. And sometimes interest rates are so low that you're actually losing money over time by keeping them in these. But what's kept me from investing in bonds is that bond yields have been so low in recent decades that I don't think they can even preserve the purchasing power of the money invested in them. Let me show you a picture that makes my point. Here's a graph that I made that compares bond yields to expected inflation. The green line on the graph is the yield on the 10-year bonds issued by the U.S. Treasury, which I obtained from the Federal Reserve Economic Database, or FRED. The graph shows the bond yield measured on the first day of each month for the past 30 years. The red line is expected inflation. This data comes from the University of Michigan, which surveys consumers regularly to construct its Consumer Sentiment Index. That line is the inflation rate that people expect over the next 12 months, according to that survey. The picture shows pretty clearly that the relationship between bond yields and expected inflation changed dramatically during the global financial crisis of 2008 and 2009. Before the financial crisis, bond yields behaved in a way that I think is normal. Yields stayed above expected inflation by a healthy amount, usually between 1% to 3%, although occasionally expected inflation would jump up above them, but only temporarily. After the crisis, though, 10-year U.S. Treasury bond yields fell below inflation expectations and have pretty much remained below them. The picture is the same or worse among Treasury securities with shorter maturities, like 5 years, 1 year, or 3 months, which typically pay an even lower coupon. And if you look around the world, you'll find a similar story in most developed countries. Now, national governments are generally the biggest players, but not the only ones in the bond market. Corporations issue bonds, as do local and state governments, and mortgage-backed bonds are also a big part of the market. And they usually have better coupon rates to compensate for the higher risk involved. But while at the height of the corporate bond movement of the 1980s, yields of 15% or more were not unusual, in recent decades, corporate and municipal bond rates have also tracked downwards, so that their yields are usually not much more than 1% or so higher than what Treasury securities offer. So we have to ask, why has this happened to the bond market, and is it the new normal? In my opinion, the reasons why bond rates have stayed so low for so long have to do with how the bond market works, and more importantly, which players in the market have had the most influence over bond prices and yields. But before I get into this, let me explain where I got this expectation that bond yields should cover inflation and then some. After all, maybe the problem is with me. The idea that bond yields will usually be greater than expected inflation comes from the economist Irving Fisher, and the proposition that bears his name, the Fisher effect, which he first described in 1930. The Fisher effect says that any quoted interest rate consists of 2 parts. One part is the average inflation rate that's expected to occur over the life of a bond. The other part is the inflation-adjusted return, also called the real return, that people demand. Economists represent the Fisher effect as the equation I equals R plus pi E, where I is the quoted or so-called nominal interest rate on the bond, R is the real return, and pi E is the expected inflation rate. Fisher's proposition was that people demand to be compensated 1-for-1 when it comes to expected inflation. This means that people want to be paid high enough interest rates so that the money invested in a bond won't lose its purchasing power relative to the market for goods and services. The real return, on the other hand, is the compensation that people expect while waiting to be paid back, as well as for bearing any risk that the bond issuer defaults. So the Fisher effect promises exactly what I said I want from a bond yield. It should cover inflation plus a little extra. And most economists think that this is a good way to represent bond yields and how they react to inflation. But there's a practical problem with the Fisher effect. We don't have any way to precisely and objectively measure either the real return on bonds R or the expected inflation rate pi E. This means that my personal estimate of the expected inflation rate can be very different from the bond market's estimate. And it's certainly possible that my expected inflation rate is much higher. After all, I grew up during the high inflation era of the 1970s and 1980s. In fact, one of the reasons I became an economist is that I was fascinated by the problem of high inflation and how nobody at the time seemed to know how to solve it. That experience has stuck with me and might still be biasing my expectations about future inflation. But if we look at the graph again, notice that the expected rate of inflation has remained fairly steady over the past 30 years, close to a rate of 3%. I would have to say that the graph does a good job of representing my own expectations about inflation. And the fact that the expected rate of inflation doesn't change very much during this period suggests that the expected inflation rate isn't the source of the change in the relationship. Bond yields, on the other hand, have decreased significantly over the past 30 years, especially after the global financial crisis. This strongly suggests that the source of the problem is in the bond market itself. But we have to remember that the Fisher effect describes a tendency, not a law of economics. Bond investors may want yields to be higher than expected inflation, but there are other forces that can push yields higher or lower and keep them there for long periods of time if these forces are persistent and strong enough. The first one of these forces is monetary policy. In response to the global financial crisis, the U.S. Federal Reserve introduced several new methods to influence the financial markets and the rest of the economy. It had to do this because it basically broke the main tool that it had been using for decades to steer the economy, the federal funds rate, or Fed funds for short. This is the interest rate that banks charge each other for short-term loans of reserves. During the crisis, the Fed flooded the banking system with reserves to give struggling banks plenty of liquidity to fend off bank runs. This basically drove the Fed funds rate to zero, rendering it more or less useless for stimulating the economy. So the Fed shifted gears and adopted several so-called unconventional monetary policy tools that had never been used in the US before. The one that made the biggest impact on the bond market was called quantitative easing. If you know a little bit about monetary policy, you're probably familiar with open market operations. This term describes purchases and sales of government bonds by a central bank. Quantitative easing was essentially open market purchases on steroids. The Fed began to buy government bonds in unprecedented amounts, purchasing tens of billions of dollars worth per month, every month. The reason for doing this was to drive long-term interest rates down by driving the prices of long-term bonds way up. Remember that as bond prices rise, this means that their yields are falling. But quantitative easing represented a huge departure from traditional monetary policy, both figuratively and literally. Before the financial crisis hit, open market operations were relatively small in scale, and their goal was to influence the market for bank reserves. Purchases and sales on the order of a few $100 million worth were enough to move the Fed funds rate up and down because the market for bank reserves wasn't very large to begin with, and the Fed kept that market in balance. But that market became oversaturated with reserves when the Fed dumped liquidity into the financial system during the fall of 2008. Now, Fed economists realized that if they wanted to stimulate the economy, and they did because the U.S. economy was sliding into what became known as the Great Recession, they had to go into the business of influencing longer-term interest rates directly. They would have to purchase enough long-term bonds to push down the market interest rates on the bonds. But the U.S. Treasury market is one of the largest financial markets in the world. So it took purchases of many billions of dollars of bonds at a time to get the interest rate on 10-year government bonds to budge, and tens of billions more to move the rate down significantly and keep it there. Between 2007 and 2017, the total amount of assets the Fed held went from under $1 trillion to more than $4.5 trillion. In 2012 alone, the Fed was buying $45 billion worth of long-term Treasury securities a month. Given those astounding numbers, it's not that surprising that the yields on the bonds fell below the expected inflation rate and stayed there. Eventually, the Fed's holding of bonds stabilized and even declined a little, all the way to about $4 trillion. But in the spring of 2020, financial markets panicked as it became clear that the United States economy was about to shut down due to the spread of the COVID-19 virus. Firms scrambled to borrow money to survive pandemic lockdowns, and this set off a classic liquidity crisis that could easily have threatened the entire financial system. So the Fed responded the way that it knew how, by purchasing piles and piles of bonds and flooding the markets with the cash that businesses were desperate to get their hands on. And it kept going from there. Do you remember the trillions of dollars of U.S. fiscal stimulus that occurred during the pandemic? Getting cash payments from the government was nice, but where did the money come from? Well, a lot of it came from the Fed. The U.S. Treasury spent more money than it took in, so it had to borrow by issuing more government bonds. And the Fed stepped up to buy a lot of them. It was an open secret that the Fed was doing something that we say we never wanted to do: print money and use it to buy government bonds. Usually, we think that leads to inflation. But during the pandemic, those concerns took a backseat to keeping households and businesses afloat. So the Fed's demand for bonds went up again. The Fed asset holdings increased by more than $2.5 trillion during the first 2 years of the pandemic, to a whopping $6.5 trillion. For a while, the Fed was buying $79 billion worth of bonds a day, and some economists forecast that it might end up buying a few trillion more. So to recap, the big change in monetary policy that took place after the global financial crisis drove down Treasury bond interest rates as the Fed bought literally trillions of dollars of bonds, pushing their prices up and their yields down below the expected rate of inflation. Similar quantitative easing policies were followed in the Eurozone and Japan, effectively flooding the international economy with cheap money. Lower interest rates and high liquidity in turn make it cheaper for banks to lend and for corporations and municipalities to borrow from them. So the yields on other types of bonds will track downwards as well, since there's less need for borrowers to offer high bond returns when they can borrow from banks instead. This is the primary reason why bonds became an unattractive investment for many people, including me. But inflation staged a major comeback during the pandemic, rising to rates we hadn't seen in 40 years. In response, the Fed suddenly changed the direction of monetary policy, putting a halt to purchases of government bonds. And you might think that this opened the door to a return to the bond yields that prevailed before the global financial crisis. After all, the Fed wouldn't be in the bond market buying billions of dollars worth of bonds anymore, right? Well, there were some other changes introduced after the global financial crisis that have also had major impacts on the bond market. One of the most important ones involved bank regulation. Policymakers realized that the global financial crisis was in many ways a new variation on an old problem: liquidity. The global financial crisis was essentially a massive run on the entire financial system. Investors began to lose confidence that they could convert the billions of dollars they had invested into mortgage-backed securities, commercial paper, money market funds, and other assets back into cash, so they all panicked and all tried to cash out at once. In the aftermath of the crisis, regulators created new rules intended to ensure that banks would have enough liquidity on hand to meet investor withdrawals, even during times of elevated stress. The main rule they imposed, which was called the Liquidity Coverage Ratio Standard, required banks to hold high-quality liquid assets at all times that could be easily converted to cash and paid out to depositors and investors if those folks suddenly wanted their money back. And the main type of high-quality liquid asset that banks could use to satisfy this new liquidity standard is government bonds. This important change has permanently increased the demand for government bonds, such that Treasury bond yields may not rise back to the levels we thought were normal before the crisis. Another big change in the financial markets after the global financial crisis has to do with collateral. We know that borrowers post collateral when they take out loans. For example, when we take out a mortgage loan, most of us use our home as collateral. When big financial institutions borrow, they also generally use collateral, even for short-term loans. And when investors engage in many types of trading, especially derivatives trading, they also post collateral. As in the case of loans, the collateral is there to ensure that traders can still pay their counterparties, that is, the people or institutions they're trading with, if they lose money on the trade and owe money to their counterparties. In the run-up to the 2008 global financial crisis, market practices surrounding the use of collateral became pretty lax. Lenders and traders allowed their counterparties to post less collateral than they had historically and to use lower quality forms of collateral. As one example, mortgage-backed securities consisting of large pools of newly issued home loans were frequently used as collateral in many deals. Of course, when the crisis unfolded and mortgage defaults skyrocketed, lenders and traders were hit by big drops in the value of the collateral. This double whammy was a distinctive aspect of the 2008 global financial crisis that made it a lot worse than many other financial crises. Markets and regulators reacted to the experience by significantly tightening up their collateral standards, both in terms of the amounts of collateral demanded for a given loan or trade, and the types of collateral deemed acceptable. More dubious forms of collateral, like low-quality mortgage-backed securities, were now out, with some market players insisting on lots of high-quality collateral. And what was often the preferred form of collateral? You guessed it, U.S. government bonds. Many market players, even foreign central banks, increased their demands for U.S. Treasuries after the global financial crisis. And they all had the same motivation. They realized that the financial markets had become much riskier, and they all wanted to take out extra insurance against those risks. U.S. government bonds were the best insurance policy they could find. Treasury securities are highly liquid, universally accepted, and almost free of default risk. This point is critical because it helps explain why so many market players bought and held Treasury bonds even though the instrument's yields were very low. They didn't care about the yields on these bonds. They held the bonds for a completely different reason than you and I might. For the big players, they're a means to an end. Holding government bonds enabled them to make more lucrative investments in other instruments, while for individual investors, holding the bonds is an end in itself. I think the financial markets are still digesting these huge changes in monetary policy and risk management. Over the longer term, we'll probably return to a more normal world in which bond yields are a bit above expected inflation, as Irving Fisher believed. For one thing, the supply of bonds is bound to keep increasing at a healthy rate as governments increase their borrowing. Supply will catch up to the increased demand. And on the demand side, the bond markets will eventually have to deliver yields that average household investors find attractive. Households such as ours are the ultimate suppliers of the funds that support the bond market. But the key word is eventually. So, what should frustrated bond investors do in the meantime? I don't think the answer is necessarily to go in search of higher-yielding types of bonds like corporate bonds. An unfortunate side effect of the changes in the government bond market we've learned about in this lecture is a phenomenon known as yield compression. Yield compression describes the fact that the spreads, or the differences in yield between risky private bonds and risk-free government bonds, have also fallen significantly. The extra yield promised by private bonds is there to compensate investors for the risk that the issuer will default. In other words, it's a risk premium. Yield compression means that the risk premium on private bonds has declined, so that investors may not be adequately compensated for the extra risk they're taking on. There may be some relatively safe ways to boost the return on your bond investments, however. For example, I think it makes sense to check the rates on Treasury inflation-protected securities, or TIPS, regularly. These are U.S. Treasury bonds whose face value adjusts over time to match inflation. So if you bought a $1,000 TIPS bond today and annual inflation is 3%, then next year the face value will be adjusted to $1,030, and the coupon rate next year will pay out on that new face value. The coupon rate on TIPS is therefore inflation adjusted, or a real return. What you need to look at and think about is whether that extra bit of real return offered by TIPS is high enough to suit you. This amount can and does vary, so you may have to check these yields for a while before that real return is attractive. Other types of bonds in the United States to consider are the mortgage-backed securities and notes issued through Fannie Mae, Freddie Mac, and Ginnie Mae. These securities carry better returns than government bonds and are still very close to being risk-free, given the explicit and implicit guarantees that come with being affiliated with the U.S. government. Another option are municipal bonds. Though their coupon rates are usually not much higher than the Treasuries, income from municipal bonds are generally exempt from U.S. federal income tax and sometimes state taxes as well, which can make them attractive. Internationally, too, municipal bonds have become a major growth area, particularly in Asia, as countries invest heavily in infrastructure and economic development. You may also want to look into bond-like investments, such as mutual funds that focused on dividend-paying stocks and real estate investment trusts, or REITs. I call these bond-like investments because they focus on paying out regular income, like bonds do. But this is a higher-risk strategy than buying and holding government bonds. First, their income streams are variable and always subject to change. And unlike bonds, stock mutual funds and REIT shares don't have a final payment of bond principal. Instead, you're betting that the shares in these investments maintain their value, which again isn't guaranteed. One of the main takeaways of this lecture is that you may be ready to invest in a market, but the market may not be ready for you. That's okay. If you know what you need from an investment, but the market can't deliver that right now, then it's better to stick with investments you're comfortable with. By thinking carefully about what you truly need from an investment, you help ensure that you'll be happy with your investment decisions. I may never end up owning many bonds, but if that happens, I'll know why, and I won't regret it.